So, okay, students, just to recapitulate what we learned even during the last class, which you have missed hearing me. So, I was talking about insurance being a legal agreement between an insurer, that is the insurance company, and the insured, that is the individual or a corporate body, probably whoever it is, whoever takes the insurance policy, in which the insured receives financial protection from an insurer for the losses that he may suffer under specific circumstances. So, as an insurance law student, you understand that insurance is a legal agreement between whom? Between two parties, basically, between the insurer, who is the insurance company, and the insured. Insured is the one who purchases the insurance policy. It can be an individual or even a corporate body. So, under an insurance policy, the insured needs to pay regular amount of premiums to the insurer. So, this is what we learned during the last class. Further, we also spoke about the literal meaning of insurance. What is, like, in a normal meaning, in normal parlance, what insurance really means. So, insurance would be an assurance contract or a kind of an assurance that is given against unforeseen or unfortunate loss that may occur to someone. For example, is accident. When there is an accident, sometimes if there is a bodily injury, the person who sustains such injury is covered by, say, for example, health insurance. And suppose there is a damage that is caused to the motor vehicle. So that by virtue of a person taking a motor vehicle insurance, or the policy would help him to cover certain expenses um, that he might incur for repairing the car or for the damage or loss of his motor vehicle or car or whatever vehicle that he's using, bike or whatever. So legal insurance can be defined legally. Insurance can be defined as a contract where the insurer agrees to compensate the insured against the losses incurred during any unforeseen circumstances. We spoke about the term premium, and we said that it is something which that is something rather I would use the word money. It is a kind of a fee that is charged where the person pays the amount to the insurance company to avail the benefits of the insurance policy. So one of the basic component of insurance is, of course, the premiums. There are different types of insurance policies that we'll be learning today. That is life insurance policy, health insurance policy, and some other kinds of policy that are there, like children's policy and so on, term insurance policy and so on. Now, there's yet another thing that we learned is we said that insurance policies are contracts of adhesion. That means there is no much scope of negotiating the contracts. We also said that insurance is a tool for risk transfer, and it is a kind of a community solution as several people who are exposed to the same risk, they pool their funds together to bear the loss. So there is something called as pooling of resources that takes place in the insurance sector. That is, everyone purchases the insurance policies, so all the amount is pooled in, and when there is a loss to a person or to a group of people or whatever, whoever incurs a loss, then the insurance company starts disbursing that amount to those people. So we also spoke about the concept of utmost good faith during the last class, just to run through as fast as possible what we learned during the last class. And we said that insurance policy does not cover, or it does not affect the chance of loss or minimize the magnitude of the loss. However, it does help to reimburse the losses that might have occurred. For example, if the car is entirely destroyed, they will not replace the car for you. They will not say, okay, I buy for you a new car. However, they might compensate to a particular percentage the loss that is incurred by the party, by the insured, depending upon the facts and circumstances of the case. That is, who is responsible for the loss that has incurred, and so on. There are other factors as well that are taken into consideration. Now, this class, we are going to confine ourselves with types of insurance policies, some legal principles, as well as, if time permits, we are going to also learn about the concept of insurable interest. And let's go on through our slides and see what does it say about types of insurance. Here it talks about life insurance. One of the basic sorry type of insurance is sorry is life insurance policy. It's the most basic policy I'm sure you're aware of. You've also answered the homework during the last class that I gave you, and I've seen your homeworks as well that is displayed in Google Classroom. So, what is life insurance policy? Life insurance policy, as name itself suggests, it covers life, where this policy ensures contingencies related to life of a person, and this form of insurance does not comport with the general indemnity principle which the concept of insurance involves. Normally, as we said during the last class, the insurance policies normally are indemnity contracts. And we said indemnify to indemnify means to make good the loss. But life insurance policy does not necessarily revolve around the indemnity concept. You understand? So there are different categories because you cannot indemnify the loss of a person, death of a person. However, this is a different kind of an insurance, and that's why we call it as contract or a policy, or rather, an agreement of adhesion. So there are different categories of life insurance, such as term insurance, wherein the sum assured is disbursed only upon the death of the insured within the specified term. Then we have this endowment insurance, which disburses the sum assured upon maturity or upon the death of the insured. Then we have whole life insurance, which is paid upon the death of a person, no matter when the death occurs. And the premiums may be paid during the life period or for a specified period, depending upon the terms agreed. There's also something called as single premium life insurance, where the entire premium is paid lump sum by the insured. There are children's policy, joint life insurance policies, and so on. The next most common form of policy is the health insurance. Now, health insurance policy is a policy obtained by the insured to cover securing health expenses such as diseases or even injury and so on. In some countries or jurisdictions, obtaining a health insurance policy is mandatory for every citizen as well as resident. For example, in Abu Dhabi and Dubai, that is the United Arab Emirates, it mandates for a health insurance policy to be obtained by every resident and citizen and they may be covered by employer if the person is employed. Next is the general property insurance. General property insurance covers assets and is based on the principle of indemnity. To indemnify, as I said earlier, means to make good the loss. So the purpose is to bring the insured to shield the investment made in the property. Homeowners insurance, fire insurance, title insurance, crop insurance for farmers may be brought within the ambit. So property insurance may have three levels of coverage, that is to the extent of the actual cash value, or replacement cost, that is for rebuilding or repairs, or even guaranteed or extended replacement loss. Next, we have transit insurance, that is goods which are in transit. Say now you send some goods by sea or air or road, whatever. So goods that are shipped by, say, for marine cargo are covered under marine insurance, and likewise, goods that are sent by air are covered by air cargo insurance, and by road is covered by a broad spectrum of transit insurance. Next, we have travel insurance. Now, travel insurance covers travel, baggage, loss, repatriation, health of the traveler, and so on. What is repatriation? Suppose a person travels abroad or he goes for a holiday abroad and there something happens to him or her. So then what happens? Suppose the person dies. So that country where he goes, that country will check the insurance policy papers, travel insurance policy papers, and with the amount that is covered there, will try to repatriate the body, that is send the body back to the home country where he belongs to. Next is motor insurance. Now, this is a mandatory insurance in most jurisdictions in most parts of the world, talking even internationally. Now, here, there are some countries have this specific insurance called as a collision insurance, that is accident insurance, or PIP, that is personal injury protection, etc. This involves third party insurance because generally, as per the law, the owner of the vehicle is legally liable to compensate for the loss, injury, or damage to any other person's life or property, road users and their passengers or the public because of the accident, or why? Because of the negligent driving or otherwise had been caused by the vehicle. Next is we have gap insurance, which is the insurance that covers a gap or the difference between the car loan and the actual value of the car. Next is group insurance. This group insurance normally revolves around the principle of contributory principle of insurance, where each member There's a group of people or a class of people who come together and they take group insurance. For example, employees of certain companies, they may get together, and based on the principle of contributory principle of insurance, all of them will, pay a specific pool. They'll pool the premiums together and pay the insurance company. This is group insurance. Next is project related insurance. Say there is a particular project, so that particular project will be covered under this particular insurance called as project insurance, project related insurance. Example of it is personal indemnity insurance. Next is you have credit insurance. Now, this is obtained in case of loans or credit schemes obtained by the insured from any financial institution or banks. Next, we have pet insurance, and this covers medical expenses for pets. Now, umbrella insurance, as the name itself suggests, is like a broad spectrum insurance, and it covers a set of properties as well as person's reputation against libel or slander. Libel means to write something against a person. Slander is to speak against a person that would defame a person. So something that is defamatory in nature. Defamation is an offense. It's crime in some countries. It is both a crime and a tort. Tort is a civil wrong. In some countries, have you learned the law of torts? If you learn the law of torts, you will know what is defamation. Defamation is a tort. Tort means a civil wrong. So in some countries, it is just a civil wrong, and the civil case can be filed. That is defamation I'm talking about. And in some countries, it is only a criminal offense. In some countries, it is both. Example, in some countries where it is both, it is India. In some part of Australia, for example, it is only a criminal offense. And some other part of Australia, they say, no, it should not be a criminal offense. It should just be, only a civil wrong. It's only a tort. Next is earthquake or flood insurance or natural calamity insurance. In case an area is prone to a particular natural disaster, then they may opt for such insurances that will enable them to reconstruct their houses or property in case of a loss as a result of natural calamity. So as the name itself suggests. Next, we have general liability insurance. Now, this covers businesses, enterprises, and even properties. It may tend to exclude coverage for riot-related or war injuries because the risk is far-flung and thus difficult to be calculated. So war injuries are not covered under this type of insurance. A commercial general liability insurance may cover a wide range of risks, including advertisement risks of libel or slander. Next is business insurance. Business insurance includes commercial insurance or even mandated by law, such as workmen's compensation insurance, commercial auto insurance, directors' liability insurance, etc. Some insurance companies may even offer KPL insurance, that is key personal life insurance, that is if a key employee dies, then the risks that may overshadow the company may be covered under such a policy. For example, say the CEO who basically runs the company. Some of the businesses have, such kind of insurance policy coverage, and they prefer to take such kind of coverage, that is key person life insurance. Next is malpractice insurance. This covers professional liability for doctors, physicians, lawyers, consultants, and other specialists against suits alleging negligence or professional errors and omissions that have inflicted harm on the clients. Next is tort liability insurance. Tort that I was talking about some time back is a civil wrong. And when a person inflicts some harm or a damage upon another, then the tortfeasor. Who is a tortfeasor? The one who commits the wrong. The tortfeasor is expected to make good the loss and or compensate for the loss caused harm inflicted to the aggrieved person. So in this context, if the tortfeasor, the defendant in the case of torts, has a current tort liability insurance, then such a policy would support the tortfeasor, the defendant in the case, to pay for the damages that may be awarded by the court, the defense, legal costs, and the allied. Workplace tort is a civil wrong committed within the workplace that may give rise to an employee's cause of action against his employer. Example, defamation, that I gave again example sometime back, disparaging remarks, demotion, etc. Thereby, there are several types of insurances, and there are still some more depending upon country to country, region to region. Now, this, as you know, the concept of insurance is continuing to evolve and to grow with the advancement and the risks that the world is advancing with. For example, the most interesting example here is the heart-wrenching episode of September 11 terrorist attack to the Twin Towers at New York City, which alarmed the whole world. Now, this incident promoted the insurance industry or prompted the insurance industry to cover losses as a result of terrorist attacks, as well as the insurance policy has been designed to cover such losses. Next is assignment of insurance policy. Normally, legal contracts contain a non-assignment clause. However, in the case of group policy, an individual insured group member may be provided this. We are talking about group insurance policy where the policy can be assigned to the beneficiary. One person who has taken the policy would say, yes, I would like to assign the benefits of my policy to someone else. So he would have or she would have a beneficiary to that extent. However, sometimes assignment of policy is not permitted. It would be considered as legally invalid because of non-assignment clause. But if such non-assignment clause goes against the prevailing law or statute in any particular jurisdiction, then such a clause would be regarded as invalid and assignment would be honored under that particular insurance policy. Next is misleading statements. Misleading statements may make the insured lose the claim. Never make false or misleading statement in an insurance policy as an insured person. So because a false or a misleading statement by an insurance policy applicant may provide for a basis for the underwriting team to reject the policy or prepare a kind of a contradictory report or prepare a report that is negative and that would go against the insured. So the insured may be entitled to file a complaint against any prohibited sales practice, for example, exhibited by an insurance sales agent, inducing a customer. This was held by in a particular case called as Bacon versus Federal Kemper Life Insurance Company. Here, what happened was the insured was entitled to file a complaint against a prohibited sales practice, which is exhibited by an insurance sales agent, inducing a customer. 1 minute. Yeah, inducing a customer to purchase an insurance policy by false or misleading statement is a prohibited sales practice. Normally, in under normal circumstances. Now, in Bacon also, it substantiated this fact and said a case which involved a forged signature where someone forged the signature of the policy holder on the change of a beneficiary form of a life insurance policy. Again, forging, misleading statements, forging, all this kind of these are all offenses that cannot be or is not permitted in an insurance policy contract as well. Normally, of course, forging is an offense. Giving misleading statements, for example, giving misleading statements or an oath is considered as perjury. So this is not permitted. So likewise, even in insurance policy contract, misleading statements must not be given. Then reinstatement of a lapsed policy. Now here, someone's entering the room. 1 minute. Let me just admit the person. So reinstatement of lapsed policy and incontestability clause in insurance contract. What is incontestability? That means you cannot file a case. Now, in case a policy lapses for non-payment of premium, then the policy holder or the insured has the option to reinstate the policy. Now, the insurer may reinstate the policy conditionally by setting forth compliance with certain terms. For example, losses during the period of lapse will not be covered. However, if a statute or a law prescribes reinstatement, then the insurance company is bound to extend the privilege to the insured without any conditions or exclusions. Now, generally across most jurisdictions internationally, the courts are of the opinion that if the insurance contract reflects the insured's right of reinstatement, then the right shall bounce back as soon as the policyholder makes good the cause of lapse and the policy will be made effective or revives. On the other hand, some courts across few jurisdictions are of the practice to permit reinstatement petition subject to the approval of the insurer, who is expected to process the application as per the terms of the insurance contract and the policy set forth and agreed to be complied with by the parties. However, in normal circumstances, in the absence of any such clause or an existing governing statute, reinstatement or putting the policy back will be entirely subject to the approval of the insurer, that is, the insurance company, who might review the matter on a case to case basis. Now, insurance contract terms against public policy. Now, naturally, insurance contract and insurance policy must be within the boundaries of law, the presence of law, or the purview of law, and not in the contravention or against any prevailing law or even the principles of justice, equity, good conscience, and public policy. In La Orange versus Medical Protective Company case here, the court observed that an insurance contract that is contrary to state public policy, no matter how clear and unambiguous, may be illegal and void. Now, the test of whether or not an insurance contract is void as against state public policy is whether it is injurious to the public or contravenes some important or established social interest, or when its purpose is to promote, effect, or encourage a violation of law. So, this is all about the types of insurance and certain important principles, such as insurance contract should not be against the public policy. Insurance contract, what happens if there is an incontestability clause in insurance contract? What happens if on the question of reinstatement of lapsed policy, that is, whether a lapsed policy can be reinstated, whether at all misleading statements can be made? The answer is certainly in the negative. It cannot be made, and that would make the insured to lose the claim. Next is assignment of insurance policy, which is not allowed, but it depends on the type of insurance policy. And group insurance, assignment of insurance policy is allowed. That means it can be, a beneficiary can be assigned there. Now, next is I think we missed this slide. Can warranty or guarantee come within the purview of the concept of insurance? So there may be an argument at times that a warranty or a guarantee provided to products may operate under the principle of insurance scheme. Now, in State X Rel Duffy Attorney General versus Western Auto Supply, the court held that a warranty or a guarantee issued to a purchaser of a product we are talking about in connection with the sales of goods containing an agreement to indemnify, that is, to make good the loss, against loss or damage resulting from perils outside of and unrelated to inherent weaknesses in the goods, however, constitutes a contract substantially amounting to insurance. However, a written warranty delivered to a purchaser representing that the articles sold are so well and carefully manufactured that they will give satisfactory service under ordinary usage for a specified length of time, and providing for an adjustment in the event of failure from faulty construction of materials, but expressly excluding happenings not connected with imperfections in the articles. Next is, we said that the concept of insurance is continuously evolving over the years. And when we're talking about the types of insurance, we said that different types of insurance just comes up depending upon like what new what they say risks that the world is facing. For example, is we gave about the September 11 attack, and thereby they came up with a new insurance policy against terrorism. So thereby we spoke about different types of different types of policies, such as life insurance policy, which is a basic policy that everybody knows, motor vehicles policy, or accident policy. It comes under that motor vehicle policy, motor vehicle accident policy, or here we are looking at a screen. We have the tort liability policy, malpractice policy, professional indemnity policy, business insurance, general liability insurance, pet insurance, umbrella insurance, group insurance, project-related insurance, travel insurance, transit insurance, general property insurance, and so on. Let me know if you have any questions. If not, we proceed to the next chapter, which is insurable interest. Again, I asked you a question on insurable interest, so I'm sure that you understand the concept. We'll go through the entire chapter together today. Let me know if you have any questions.